Hi everyone, my name is Jeff Praisman and welcome to our IBKR webinar series with Market Chameleon. It's my pleasure to welcome back Will and Dimitri from Market Chameleon and my old friends from the Philadelphia Stock Exchange. Will and
Yep.
Dimitri, how are you guys today?
Pretty good. Thank you, Jeff. Thank you for having us on again. I think like how many of the webinars we did, we've done at least like 6, I think, at this point. So it's
Yeah, I
going
think
pretty
this is 6 or
well.
7, so the
6
series
or 7. That's
is a
great.
big hit
And
with our clients, I can tell you that much.
We really
yeah,
appreciate you having us, Jeff. Thanks so much.
yeah, thanks, Jeff. And we really appreciate a lot of people are coming back. We have pretty good amount of people, decent amount of people coming to the webinar. So we just want to say thank you to all of you guys. Hopefully, today we'll do something very helpful. If you guys have questions, no problem. You can put it in the chat there. Will's monitoring it, and once you see the questions, as long as you'll stop me if it's like relevant to the point. Otherwise, we'll just save some to the end.
Sounds perfect, D.
Okay.
You want to start with the disclaimer? There's a little disclaimer, I think, for the IBKR webinars, correct?
Yeah. So Jeff, can we start now, Jeff? Is it?
Yeah, oh yeah, guys, go ahead. I'll let you guys take it away, and I'm excited to listen in on this webinar, and
All right.
can't wait to hear all about the how to screen for an iron condor. Thanks, guys.
All right.
Cool.
Thanks. So today we're going to do a screen for iron condors. We're going to talk about a couple things. But before we get into that, let's just take a look really quickly at the disclaimer here, disclosure. We'll just give you a couple seconds there to read it. And, if you want to come back and watch the recording, you could go reread it again. But there it is, everyone. And there are no questions coming in.
No questions have popped up yet.
Okay, so on today's agenda, like I said, we're going to take a look at a credit iron condor. So, you could set it up 2 ways. You could do it a debit, or you could do it as a credit. So we're going to take a look at one of them, and we'll start out with a credit iron condor. And whenever you're doing an option strategy, whether you're buying a call, you're buying a put, selling a put spread or a call spread, you have to have some kind of an outlook with that strategy, right? So you're doing it because you have a certain outlook. Either you could be either bullish, you could be bearish, you could be neutral, you could think volatility is low, you're going to think volatility is high, and that's when you kind of start putting on a strategy based on that outlook. So credit iron condor, it's appropriate when you have a certain type of outlook, and that's what we're going to talk about. And in addition to that, I'm going to show you in a payout diagram. So I'm going to set it up. We're going to take a look at what a credit iron condor looks like, because the payout diagram, what it will do is we're going to look at the markets, set it up, and then we're going to see where is that credit iron condor along a price of ranges. Where is it profitable? Where is it going to be unprofitable at expiration? And then we could compare the potential gains to the potential losses. So the payout diagram, it's a very good visual way of seeing along different price ranges where it's going to pay off, where you're going to lose, and by how much. So we'll start out those two. We're going to talk about a theoretical value, and we talked about this. We have a morning show every day. We talked a little bit about it today, what a theoretical value is. And a theoretical value for options traders, we create estimated values of securities or a combination of securities, and those estimated values help guide our decisions, because then we could compare what the estimated value is versus the market prices and see if they diverged or by how much from a historical benchmark, and that could assist us in our decision-making process. So we'll talk a little bit about that. And then if you're looking for ideas, credit iron condor ideas, and maybe you have a certain group of stocks that you want to screen for, or you want to just screen the entire market, see how things are lined up, then you would need a screener to be able to scan different setups and then produce to you some results and statistics along the way, right? So these are the things kind of that we're going to look at. And I probably already talked a little bit about it, but what is the outlook if you're selling a credit iron condor? And we're going to see it. But in general, you think that there's not going to be a lot of price movement in the stock. Okay, so the idea is you're going to collect premium, You're going to pick strikes where you think that the stock is not going to go above a certain price, strikes that you think the stock is not going to go below a certain price, and we're going to arrange it where we're selling the put spread, selling the call spread, and if you're correct and the stock lands in between these prices, then you're going to be able to keep that premium that you sold it for. Okay, so that's the idea. You're selling premium and you're hoping that all the options that you did expire worthless, and at the end of expiration, options go away and you keep the premium that you sold. All right, so we're going to see it a little bit even visually when we set it up. And that's what the payout diagram will help us do, look at it visually, and then we're going to be able to quickly see where our risk is, where the reward is, and we'll be able to compare that. Okay. Theoretical value, we talked about it a little bit, and we'll go over theoretical value. And there's certain questions I get about theoretical value I'm going to try to clear up along the way as we're talking about it. But again, this is something to help guide us in our decision-making process. Okay, so when we're just looking at the markets alone, we're not sure, are the markets high, are the markets low, are they fairly priced, and if they're high or low, how far away are they from a benchmark, an estimated value. And that's what we're talking about when we're going to look at a theoretical value. And then finally, then we're going to go to a screener, and we're going to go and just screen for credit iron condors, and we're going to use filters to narrow down choices. And then we'll talk about it. We'll go to the options chain and make an evaluation or a deeper evaluation. So from that, that's what's on the agenda. And I'm going to exit this, and I'm going to go to the Market Chameleon tool. All right, and I set it up here. So this is under screeners, and you could see there are different types of screeners and different types of strategies based on your outlook. This one has a particular type of outlook that we're going to talk about, and here it is, the iron condors, and this is where we're shorting the strikes, the inner strikes, and buying the outer strikes to protect ourselves from a very violent move. So we're stopping ourselves out. So I'm on here on the iron condor, and let me just quickly, sorry, I just switched screens and left. So I'm going to go really quickly, kind of the data below, go over what that means. And before we do a screen, I'm going to go and actually to the options chain and set it up and kind of walk you guys through it, and then come back to the screen. So I'm just going to use my pre-selected filters for now to see what it's screened out, and then we'll just go over the different data elements on there. Let me see, one second, let me just refresh my screen really quickly. So as we're waiting, the idea here is that you could see, oops, sorry, Will, can you hear me? Because I think that my computer slowed down. Will? Hello?
I can hear you perfectly.
Hello? Okay, sorry.
Right, yeah.
On my end, it's going very slowly, so sorry about that.
No worries. Listen, when you say pre-selected, where does that come from?
So those are just filters that I generate. So when people need some starting points, there are filters that I save, just so you guys kind of get a starting point. But from there you could take it and. So sorry, one sec. I'm gonna bring up a different screen. Not sure why.
Now listen, when anyone's using Market Chameleon and have any issues like this, they want to go and email support@marketchameleon.com. It may be a refresh situation with your computer. It could be issues, but when Dimitri mentioned he gets questions quite a bit, a lot of people email support@Market Chameleon, and we try to get to all the questions people have. So that's where some of these questions come from.
Yeah, just let me see why I'm getting this slowness. Just gonna close some stuff here.
No worries. Also, for those who don't know or are joining us for the first webinar, Dimitri and I do a morning show every morning on YouTube, 9 a.m. It's our pre-market show, and typically we go through what's going on in the morning with movers in the market, in the pre-market, and then we'll get into some aspect of Market Chameleon where things typically where D are seeing interest in things, and we'll walk through the community through the use of the Chameleon.
Yep. So really quickly, I'm gonna go back to that iron condor. Not sure why I'm getting this slowness, but maybe it's, because I'm looking at my other computers, it's not getting it. So I'm
Hey,
not
D,
sure.
we did get a question popped up.
Yep.
They're
Okay.
asking, it's Wayne is asking, what does best theoretical edge +7 mean on DM screener? He's asking what exactly does that
Okay, so
title
that
mean?
was plus 70% win rate. Again, I don't know why I'm getting this. Hold on one sec. Let me just see really quickly if I'm getting it. Let me just close this. All right. Well, I might have to reboot the computer, unfortunately.
That's fine.
Can I get
Hit the
back in?
reboot.
Let me just reboot my computer.
Sounds
really
good.
quick.
We'll keep
All
everyone
right.
going.
Sorry, guys. All right.
So as Dimitri reboots everything up, just I'll go through a couple things that we do for our Market Chameleon community every day. We have a, like I said earlier, a live show every trading day starting at 9 a.m. on YouTube. I'll put the YouTube channel link in the chat. It's useful, and the Chameleon community, which is a relatively large one, we have probably a couple hundred people who join every day. And we also have a Discord community that a bunch of traders who use Market Chameleon created. Dimitri and I aren't intimately involved with the Discord, but if anyone wants access to that Discord link, it's a free community of like-minded traders. I say like-minded, they often debate their trade ideas, but it's a discussion forum, and a lot of them do use Market Chameleon amongst other tools to trade. Most of them, well, I should say about 50% of them are Interactive Broker portfolio margin customers who use Market Chameleon as one of their tools in their war chest. What kind of questions? I didn't get DP's answer to my question. All right, Wayne, that 70%, that plus 70 is plus 7 is plus 70% win rate, and we can have Dimitri explain that when he comes back. But that's basically back testing the strategy, and in the back test, it has been a winning strategy 70% of the time over the back test. But we can go further into that with Dimitri when he returns. Let me start putting some of the links in. First, I'll put the link to the YouTube, which people definitely find helpful. I just sent that YouTube link to everyone. Feel free to join us in the morning, ask questions about Chameleon, the market, anything you want when you join us. All right. Depends, I see Kevin. The website is free for probably 70% of what we have on it. It's a free internet service, marketchameleon.com. I can put the link to that, but obviously you can go type into your browser and get that. Again, that's marketchameleon.com. The services range from, well, I'll bring them up right now so you know. It's, I think, $39 for the dividends, $59 for the earnings, I think, and then $99 for a full inclusive monthly fee, and that's everything on the site from the premium side, as well as you get all the access to the email, the support, the YouTube channel. Everything we do is there for you. Wondering if that's Dimitri trying to come in. Any more questions? Hopefully that answers your question, Kevin. You know what? I can actually send you the link to the fee structure so you can see it. So I just put the link to the site. You can check the fees on the site there. Also, when you register for free, there is you get a bunch of email options for earnings, dividends, to kind of walk you through how the site would work for you before you make a decision. Then we have a 7-day free trial on top of everything that's available. So the full package, unfortunately, I can't share my screen. Stock trader is $39 a month. Options trader is $69 a month. The earnings trader is $79 a month. And the total access, the full suite, is $99 a month. So those are the different payment plans for the service. Ivan's asking how long Market Chameleon's been in existence. Well, we didn't get into it, but Dimitri and I started on the floor of the Philadelphia Stock Exchange with actually Jeff Braisman. We all worked for, at the time, it was Timber Hill, which morphed into Interactive Brokers. And that was really the seeds for what eventually became Market Chameleon. But Dimitri and I traded together. D, you back? I see Dimitri's back. He may have to turn his mic on. Make sure you turn your mic on, buddy. Is your mic on?
Do you hear me?
Yeah, I can hear you now.
All right,
So how long
sorry,
were we on
everybody.
the floor together in Philadelphia? I forget.
In Philly?
Yeah.
Oh, I think like, I don't know, in Philly, like at least like 2 or 3 years, and then we moved to New York Stock
Yeah,
Exchange.
and we
Or the
worked
American
together, I
Stock
think, at Timber Hill for at least a year, year and a half, correctly, with Jeff?
Exchange. Yeah.
Yeah. And from there, then Dimitri and I went and worked with two guys hired us from the floor, John Diamond, Al Carter. We worked for them for almost 3 years, 3.5 years.
Yeah, I
And
think
then
so.
that morphed into MP Capital, which now we traded, we streamed into the CBOE, the BATS, and the PhilX. And then from there, we started Market Chameleon. They were just asking about how long Market Chameleon has been around. I was giving them a little background.
Yeah, so I think, what are we, like on year 4, I think.
Year 4 of actually live Market Chameleon via the internet, yes.
Yeah, so it's been pretty good, and
Yeah, it's
got a
been
lot
a
of
nice.
support. So a lot of people on today's show probably are using Market Chameleon, so we really appreciate it, because, you know, in 4 years, we didn't imagine that we would have this many people coming to our website and using it. So, you know, thank you to everybody out there who's supporting us. But look, my apologies. Not sure what's going on, why I'm seeing some of this slowness. So hopefully I don't get it again. Let's take another crack at it. Do you see my screen right now, Will?
I do, yep. We did we did have a question from Wayne, who was asking initially Best Buy theoretical edge plus 70% win rate. He wanted to know what win rate meant.
Right. So that has to do with the theoretical edge and the statistical analysis on the options themselves. And I'll actually go over that. So once we go over it, you'll kind of understand it more. And that's over here. See, this is the win rate This is the theoretical edge. So let me go kind of through some of these data elements. And then once we go through the data elements, we'll talk a little bit about what these mean. But I think also what we'll do is take a look at what the payout diagram looks like, so people get a visual of what you're actually doing with this particular strategy. All right, so right now I kind of already set it to our preset screener. Like I said, these are just filters that as starting points, but you could use any filter that you want on here. And here we have, the symbol, Google. This is the price and the price change. This is the market cap. And here we have these are the legs of this strategy that were filtered out. So we see an October 29th expiration, and this little E is saying that there's going to be an earnings that, this expiration will cover an earnings event. We'll talk a little bit more about it. We could filter that out, but this is going to price, these are going to be priced based on historical earnings. And we see that the expiration, and there are 4 legs to the credit iron condor, right? And essentially what you're doing is selling it out of the money put spread, and you're selling it out of the money call spread. So this is what it looks like. You're selling over here. These are the put side. So you're selling the 2,600 put, buying the 2,500 put, and then you're selling a call spread. You're selling the 2,845 call and buying the 2,945 call. So Google, obviously very highly priced stock, and this is the credit iron condor that it's analyzing, October 29th. Here it's saying that what is your max gain? Well, the max gain is whatever we could sell it for, right? So whatever premium you could get for that strategy, that's what you could sell it for. The max loss here is if you have to buy it back, if the stock goes above, all the way through your outer strikes, either up or down, you have to buy it back. So this is we could see here, this is $100 spread one way, $100 spread the other way. So if it's totally in the money, you got to buy back at expiration for $100. So if you buy it for $100 and you sold it for $33.70, that means that you lost $66.30, right? So what is your potential profit? Well, the potential profit is, if you're risking $66.30, right, $66.30, and you could potentially make $33.70, that's a 50% return on what you're risking. Okay, risking 66 to make 33. All right, so that's kind of the data elements going over here. The question was on this, so I'm going to come back to this because it takes a little bit more explanation. But before we do that, let's just take a look at the visual. So by clicking on this October 29th, it's going to take me to the options chain for Google. And what it'll do is pre-select automatically all the different legs to that spread, right? So what it'll do is select all these different legs for the spread, and then we could run a payout diagram on it and just take a look at what that would look like at expiration. Where would it be profitable? Where would it be, where the risks are, how those strikes are. So let me see. Again, not sure why I'm getting this slowness right here. So while we're waiting for that, I don't want to have to reboot again the computer, but while we're waiting for that, I'll talk a little bit about that theoretical edge and the win rate. So what this is telling us as traders, what we want to take a look at is say, okay, if the market price right now is $33.70, and we know that the stock has to remain in between these different strikes, right? What historically, based on how the stock moved, right? That's what this is going to do. It's going to look at the history of how this stock moved. I'm going to open this really quickly, and what it will tell us is what on average is the end value of this particular strategy. Okay, so this is what it's doing. If you open it up, right, we know that if the stock moves below the low strike of 2,500, 2,500, we have to buy back. We're going to have to buy this back for $100, right? If it goes above $2,945, we know we got to buy back for $100. So that's where it's going to be worth. And anywhere in between this, it depends where it lands, right? So if it lands anywhere between these strikes, it's worth 0. If it lands anywhere between these strikes, it's going to have a value depending where it lands. So, if it goes down, and it goes to $2,550, it's worth $50. If it goes up to, let's say, 2,900, that'll be worth $55. So what this is doing is saying, based on history, right? And it's looking at 6 years of history and says in the last 16 years, now we know that there's going to be an earnings, right? The machine already knows that. So filter out in the last 6 years all the data that covered earnings with the expiration, right? Same days to expiration, 13 days. So that's what it's doing. It's lining up the data just like we see it today with an earnings covering these options. And then says, where did this land historically, right? So here's all the data below, right? And based on those returns, it comes up with an average end value. So an average, it was worth $27.21, right? So here on this date, it was $33.61. Here it closed in between, it was worth 0. So that's what it's doing. It's going through calculating, well, what is that average end value? $27.21. So where are we selling it? If we could sell it today, well, if we sell it today, $33.70. So you could see there that based on that, we're selling it above the average. So it's kind of like we're getting extra, right? We're getting extra above the average. How much extra? We're getting about 9.8%. Okay, 9.8% extra above that average. How many times? Where does this win rate? Well, besides the average, what we want to know is, well, what is the frequency of times that the end value was, because we're selling it at $33.70. What is the frequency of times that at expiration, the end value was below $33.70, right? Because that's where we profit. We have to buy back cheaper. So we want to know the frequency of wins, and that's what this is. 75% historically, the end value you see here was below $33.70. Not every time, but 75%. Okay, so those are the statistical analysis helping us or guiding us with our decision. All right, let me know if you have any questions on that one. But I'm going to go here to the options chain, so you could see here, it took us to the options chain, and here it is. It populated the different legs for us. Let me just see. So you hear buying, right? The 2,500 put. So this is what it's doing. Sorry, I got buying the 2,500 put. Probably should have picked some lower priced stock, but here, the 2,500 put, $19.80, right? Selling in October 29th, the 2,600 put, $36.30, right? Then it's going up. That's the put spread. Then it's going up to the calls. It's going up and saying, okay, buy the 2,845 call, $32.90. And wait, I'm sorry, 28.45. And then selling the 2,945 call over here. Okay, so let me run that strategy. I'm gonna hit load, and it's gonna draw a payout diagram for us. Again, not sure if it's like the webinar running in the background will, because I'm getting some like, some
Error messages?
yeah, with the web, I'm not sure like when I downloaded that webinar if it took, but let me just take a look. So this is what the payout diagram looks like, right? So here we see where this green line is. Along this green line, here are the stock prices below. So along this green line, that's your max gain, right? Whatever you sold it for, 30. So at this point, $34.50, and the markets are changing a little bit. So $34.50 here. So that would be up here, anything in between these strikes. And then if the stock falls well below, you could see here that that's where you cross. There's your break even, and then you're stopped out because you own the wings, right? So 24.49 is your loss on that side, 65 on that side. So you could see here how that payout diagram looks like at expiration. And I'm gonna just do this real quick. I'm gonna just plot, let me see. Again, I'm not sure why I'm getting the slowness low, but I don't want to reboot again, but I do see
Yeah,
something.
it could be your computer brought something into the system that is slowing everything down. It could be a bug or something. You may have to.
Okay. Yeah, so not sure, but here really quickly, see what I just did was plot the last 12 earnings moves. So these lines are telling us based on historical percentage moves, that's where the lines would fall. So you could see here how many times they fell where the percentage moves were small, that they would fall into that max gain level area up here. See here, and how many times they fell outside and by how much, right? So you can see here, the times they fell outside was a little bit skewed towards the upside. That's what it looks like. So Google had the very big shocks. It looks to me like it was to the upside historically, but that's the idea here, and you have to make that decision, if this is enough, 34.50. But here, one thing I do see is that this is very wide, right? 34.50, 40. So maybe if you could get it for better, right? Here's the midpoint, 37.25. So if you could get it for better, it will cover a higher area, right? So the more you sell it for, the better outcome, or the better it is for you, because, right, you sold it for more, so you cover a bigger area of profit. Does that make sense?
Yeah, actually, you always want to be aware of that midpoint, correct?
Right, because here what we did was scan it based on hitting the bid, but that midpoint you could see is far away, so 37.25, and you could try to even sell it above the midpoint, but you always should be aware of that, because those markets, the wider they are, the more it costs you to get an immediate execution. So when you see wide markets like that, remember you could always use limit orders and try to get better executions. Okay, so that's really quickly what this would look like in a payout diagram. Any questions on that?
Nope, that's perfect. We are getting a lot of questions kind of
Sure.
around options and the market. And
Okay.
what I'm going to do is, and a lot of them are really intense and in depth,
Okay.
but they're not really, there's a lot of wording in them, and I may not bring across exactly what the individual wants to say. I just wanted to let them know when we do our morning show every morning on YouTube, we allow people to come into the Zoom and ask their questions live. And these questions would be really nice if we could answer them live, because they're really in depth and really about other things to do with the market, not necessarily screening for the Iron Condor, showing what you're doing. So if you get in your message a link to the YouTube, just come and join us in the morning and ask that question. We'll be sure to get to it. Actually, yep.
Well, did you want to ask me the question now?
Well, there's one question which is shorter, and they asked about the win rate, and when you're back testing, they're saying how effective is that, is what they're asking.
Right.
With them.
So when when you say how effective it was, and we did this in the morning, we talked about theoretical values, you know, and some people misunderstand what an estimate is and theoretical value, where they mix it up with a prediction, right? It's not a prediction, it's kind of letting you know, giving you a benchmark to go off by, and it's a starting point. So the example I gave this morning is, you know, if you're a football team and you're a coach, and you know, unfortunately I took off that image, but you know, and you have to decide, it's 4th and 1 and you're on a 40-yard line, right? So I'm trying to paint you a picture, and your kicker is 90% from the 40-yard line, right? Do you kick it or do you go for it? So that's one data point I just gave you, right? If you didn't know that, you know, that one data point, you're not sure what to do. But now you know, okay, my kicker is 90% from that. But you also might want to know, well, what is our conversion on 4th and 1? Is it 50%, 60, 70%? And that's giving you some data, some information to help guide your decision. That's what this is doing. But you have to look at other circumstances around her. And we gave this example. If you're on a 40-yard line and the wind is blowing really fast the other way, well, that might not be effective at all, you know, even if he's 90%, but now you have more information to say, hey, you know what, there's wind blowing against you so badly, you have to make that decision. Remember, you're a trader, and as a trader, there has to be human intervention, and you have to use your logic. You have to use your common sense. You cannot say, here's a number, I'm going by it. If you're not using your logic and common sense and using all the data and information available to come to a good assessment of the information, then you're no longer a trader, okay? So as a trader, that's what you're trying to do. So if I'm seeing that 90%, but the wind's really against me, then my decision is going to change. And that's just like here. How effective is this 75%? Well, that's one data point. But the wind, think of it as, you know, or the sun in your face, it's like market conditions. You know, maybe Google, you know, tends to go up during earnings or not moving up, but if there's a coronavirus event, or you know, or people are fearing inflation, or there's something going on, you have to handicap that. That's your job as a trader, okay? There's no way around it. Nobody's going to hold your hand, you know, either you're a trader or you're not. So that's what I would call market specific risk. Let's say something else. Here's the same scenario. And let's say he's 90%, your kicker's 90%, and the wind, no problem, no wind, sun, no problem, no sun. But you have another piece of information. Let's say you know your kicker injured himself during practice, right? Or he has a cold, he's off a little bit. 40 yards is kind of far. Now you have another piece of information, right? And that's what we would call firm specific risk. So for example, Facebook right now, you know, has firm specific risk. Why? Because there's a whistleblower now, and that didn't happen before, you know, where all of a sudden you're getting a bunch of negative news, you're getting negative headline news, you created more uncertainty with regulation. So even though we're seeing something 70%, all of a sudden we have to take that information in and use it as a handicap, right? So if you're not using all your information like that, then you know, it's kind of like a coach ignoring, hey, here's 90%, go kick it, but you're like, hey, but you know, you got the wind in your face, your kicker, you know, sprained his foot, then if you're not taking that information, and then you know, then it's not useful to you. So again, when you say high reliable, it's reliable in the sense that this is what happened, this is the data, right? We didn't make up the data, but how do you use it? That's up to you as a trader, okay? Because you're using things to assist you, right? Think about every play the coach uses, it's to assist them. You know, should he kick it from 40 yards? Should he not? Should you go for the for the first one. And then there's other circumstances, right? Like maybe you have to kick it if there's only 2 seconds left in the game and you're down by 2, or if there's 1 minute in the game left and you're down by 6, you have to go for it. So all this stuff is, I'm just showing you one tool to help you along the way. Does that make sense? So you're using one tool to help in your decision-making process.
Yeah, that makes sense. Thanks, Steve.
Yep.
We did have a question from Wayne.
Yeah.
We're using Google as an example, obviously a very high priced stock. And there
Right.
are only so many of those out there, but he was asking, in a stock like the example Google you're given, is there a way to screen, say, strikes that are $200 or $300 apart per side rather than 100?
You mean like screen?
A wider spread, I guess, rather than screening $100. Can you screen $300 or $200?
Well, so we not the width on this one. We don't have where you could screen by the width of the spread, because it'll just go through many of them. And what it's doing is saying is that it's not the width of the spread, it's basically how much of it you cover, right? Like what, so if this was $10 spread, then this would be 6 versus 3, so it's just proportional. So it's doing it by percentages. So when we look at finance, we look at percentages. We use, instead of like raw dollars, right? So we look at, really, we're using, that's what we're using as percentages. Okay,
right,
to make those assessments, right? So, yeah, it's a higher price stock, but you're comparing it by percentages. What is better, so you could here's one that's, lower priced, $10 wide. But again, all the numbers are proportional, right? So here, your potential gain is 45% versus Google 50%. That's how we tend to look at things, using percentages.
We did have a question about iron condors from Sunil, and
Yeah.
they were asking, will this strategy work for index options such as SPX?
Well, you could definitely use them on index options. It doesn't have to be restricted to like a single stock equity. You could use it. Let me see if it filtered out.
Well, you could actually screen for SPY, right?
Yeah, you could do it on you could screen it for SPY, which is trying to mimic the S&P 500, but so didn't find any that met these conditions. But let me just see if I move. Let me see if I cleared this, if we could get what's going on in SPY. But yeah, you could definitely use it on indexes. You could use it on ETFs or individual stocks. The benefit may be on indexes and ETFs is you don't have that firm specific risk, right? Like like Facebook has, or an earnings event. So definitely yes, you could do on whatever is optionable, really.
All right.
So again, not sure why I'm getting this loading, so I apologize, because when I'm not logged into the webinar, it doesn't, and I'll try it for next time. It didn't happen before. When I'm not logged in, it's quick. So something might be going on in the background that I'm not sure.
Listen, tomorrow morning, I don't want to seem like I'm plugging our morning show, but maybe we'll do a screen tomorrow morning on the morning show for iron condors, just so everyone can see it who came on today and we're not able to get a screen out. We do have some questions. I mean, since we can't screen for the iron condors, we have some questions about IV. I don't know if you want to take them.
Yeah.
So Lauren is asking, what role does implied volatility play in the theoretical assessment? I don't know if that's a general question to the market or to the, I'm assuming it's to the iron condors.
Right. So that's a good question. And so we know that, implied volatility is one way, a metric that we use to price options, if they're high or low. And the theoretical value here, so when we talk about implied volatility, and when you're doing iron condors, there's a couple other things going on besides the options being in general high or low, because you're selling options and buying options. So you're also doing skew, right? So because I'm selling one option, I'm buying a different option, then selling this and buying this. So now not only are you kind of net selling options, but you're also trading skew, right? So if the outer wings are skewed, even if volatility is high, but the outer wings are skewed very high, then what you're doing is you're kind of selling that, those wings. And the theoretical value itself is saying this, that it's looking at actual returns, stock returns. So this is an SPY right now. I'm going to see if there's any positive edge. But what it's doing is saying, based on historical outcomes, what is that estimated value? But what it's also doing is that the model, so remember, this is a model. When we estimate values, we're using a model, and the model is going to spit out whatever assumptions and inputs we put in. So in this model, when we look at historical data, what it will do is by default, and you could change it, but by default, it's going to look at the data that is more in line with where the implied vols are today. So if the implied vols are high today, whatever, let's say in the 20s, it's going to look historically when vols were in the 20s, when 30-day IV was in the 20s, how did the stock tend to perform, by expiration? And that's what this is, that's what this model is doing. So when it's looking at the theoretical value, right now it's underneath, but when it's looking at the theoretical value, it is taking into consideration where the implied vols are today. Because if the implied vols are high, the expected moves are supposed to, are the expected volatilities, the future volatility is expected to be high. So what happened historically in those same situations, and that's what this model is trying to show you, right? That on average, this ended up in SPY, right? October 15th. If you did this iron condor, right? On average, it ended being 240. So right now it's 208, so it's below average. How often did it end being, how often were you able to buy below 208 at expiration? That happened 52% of the time. And again, that's based on historical data, but you would have to also take anything else into consideration today that might impact it. Okay, so remember, that's your part of your part as a trader is to continue to research it to see, well, how else would I handicap it? Maybe you think volatility will be much lower than average, and then you handicap it that way, or you think, well, I think that volatility might actually be higher because, maybe with all the inflation fears, bottlenecks, all these systemic risks have the potential to make volatility go up. Maybe not in the next couple of days, but if you're going out further, and then you compensate it that way. Okay, so you're using your data and your benchmark along the way. And when I say this is, I understand like some people are using it for the first time and asking good questions because you want to know how to use it, but a lot of it is it comes from experience. Okay, so only with experience are you going to learn. Just like, playing chess, there's no way to play a perfect game, but you get better at it and know how to use it from experience. Like a football player, only from experience. There's no one thing to tell. There's no compensation for lack of experience, because there's nothing I could say to you, until you've experienced enough different situations and outcomes and how to use things together. but this is a tool to help assist you. Okay, that's what it is. It's a, and just like I gave an example of today of a a person kicking a field goal, right? But it all depends. Do you kick the field goal? Maybe he's 90% from 40 yards out. And if I told my wife that, who doesn't know football, she'll say, well, he should kick it every time. But I'm like, well, wait a minute, but if it's first down and 10 to go, you don't want to kick it, right? Or if it's second down and go, you don't want to kick it, you want to keep going. And, and then, but so she'll tell me, okay, so if it's first down, then you never want to kick it. And I'm like, well, there are exceptions to that too, because if there's 2 seconds left in the game and you're down by 2, then you have to kick it. There's, because you could win the game. So that's what I'm talking about. Even something very simple that you think like, well, there's just one right answer. There's not. It's it comes from experience to actually know how to use things effectively.
Yeah, it's funny you use that football analogy, because it's a football coach who's now coaching in college for the first time.
Yeah.
But his whole theory was based on math, and he never kicks off deep. He always onside kicks. He never punts. He always goes for it, 4 plays, always 4 downs. He does all these things that statistically, through his math has shown over time will produce better outcomes.
Right.
So I mean, it is really interesting how each person approaches the game.
Yeah, exactly. And from experience, you're going to start learning it actually, how to actually use the tools and navigate yourself and manage your risks, look for good trades. When is it a good trade? How do you identify it? So again, like experience, there's no way around it. Any good trader, it's only going to be from experience. There's never going to be something that you're going to just turn on and it's magically just going to gift you, with the answers. It doesn't work that way because markets are dynamic. They're moving around. There's lots of factors in there, but the tools are there to assist you, make it easier for you, and help guide you with that decision.
Good stuff, Dima. With all the technical difficulties, we're almost there. It's 2:52. I promised everyone maybe tomorrow on the morning show, I've put the link out there to both the Zoom where you can ask questions live, or the YouTube channel. And actually, the YouTube channel is a great place because it's wonderful content. There's a lot of it, and there's no charge to start learning.
Yeah.
You don't have to subscribe to Market Chameleon day one as a premium member, right? There's a lot of great free content on marketchameleon.com. Come to the YouTube channel, watch videos, learn, join the Discord. There are lots of ways to improve your game and develop your strategy. But exactly. I do believe long-term having Market Chameleon in your corner is a great benefit to you as a trader, investor. Great job, Dima. Thanks so much, buddy.
Yep. Thank you, everybody. Apologize for those delays there, but hopefully, next time it won't be there. I'm going to try to check out why that's happening. And again, hopefully you guys join our show tomorrow morning, in a pre-market from 9 to 9:30.
Excellent. Hey, Jeff, you're back.
I'm back. And, Dimitri, I feel like you're maybe directly relating this to the Colts Ravens game last night with field goals. I don't know. I may just be talking out of the box here, but
I'll tell you, and the reason football is on my mind is because, I'm from Philadelphia. The Eagles had like this great victory and it was really exciting. So it's been on my mind. So then I just started using
Look, from a true Philadelphian, any victory is great for our team, right?
Yeah, exactly. Yeah. So because I thought, okay, well, it's over, but it was a very exciting game. So that happened to be on my mind. So I use that as the example.
Yeah, just so guys, that we're getting some questions about our morning show. It's 9 a.m. Eastern time. Both Dimitri and I are located around the Philadelphia area, New York City area. So we're 9 a.m. Eastern time, that show. And I've put the link in a lot of places. I'm assuming everyone has it. The Zoom. I think that all the questions sit out there, right, Jeff?
Yeah, I believe so. And then also, I know there were some questions regarding, I don't know if you got to them, but this is definitely recorded and will be sent out to everyone after, I believe this evening is when everything gets sent out. At some point this evening, the recording gets sent out for all the
So
viewers.
you'll receive an email with the recording, as long as, everyone on is obviously registered. So everyone will receive a recording of this content. So it's good stuff. Jeff, thanks so much for having
Guys,
us.
thank you so much. I look forward to having you guys back Tuesday, November 9th for another great webinar and very instructive. And again, always a pleasure.
Yep. Thank you, Jeff. We really appreciate it. Thank you to Interactive Brokers and the community. It's been great. We'll see you guys next month.
Yeah, thanks for joining
Sounds
and
good,
sticking
guys.
with us, everyone. Thanks, Jeff.
Thanks,
All right,
Jeff.
have a good one, guys.
Byron.